Hello, everyone. Welcome to this webinar sponsored by Savvly, your personal pension designed to provide lifelong financial security and peace of mind. I'm here with Jeff Leonard, the Global Managing Director of Financial and Retirement Services at Arthur J. Gallagher. Welcome, Jeff.
Thanks. Good to be here.
So before we dive into retirement and what you're hearing from people, from employees, et cetera, I'd really like to start off with something personal. Please, like, would you mind sharing your journey of how you got into this space and what brought you to where you are today?
Yeah, so I grew up many years ago in the retirement consulting business as a consulting actuary on the defined benefit side, but then moved into various different elements of the business, got into defined contribution consulting and executive benefits consulting and investment consulting. And
Well, one
um,
second, just for our audience, can you just define defined benefits and defined contribution? Because not everybody's going to recognize those terms.
okay. So, defined benefit consulting, think about pension plans that used to be offered to a lot of employees in the US. And then defined contribution consulting is 401k plans, those types of plans, 403Bs, et cetera. And then the investment consulting that surrounds the assets under those plans. But now what we've gotten into is really how do we help the individuals where we've been helping the groups, the employers that sponsor those plans historically. Those plan sponsors now are saying, "Hey, how can you help my people more with their financial well being?" So that's kind of been my journey over the last 30 plus years.
Okay, awesome. So just again a little bit more detail on that. So with defined benefit, people pay in, and regardless of what they pay in, they get some kind of fixed payment every month, right? Like so, like pension comes out, and the company manages the responsibility of making sure that they can pay that payment. Correct?
Right. Well, the employee does in a defined benefit plan typically does not pay anything in for that
Okay.
plan,
Okay,
so
they
it's
don't even pay
totally
anything.
employer sponsored.
Totally employer sponsored. Okay, fantastic. And so then defined contribution, the employee pays in, and whatever they get out of it is just based on how well their investments do and how much they paid in. And the employer is kind of more hands off on that approach.
Well, the employee in in most plans, the
Mhm.
employee pays in and the employer pays in as well. Typically, the employer in most plans will match a
Okay.
percentage of what the employee pays in.
Mhm.
Um, so, for example, if an employee pays 5% and the plan says that the company will match 100% of the first 5%, then the employer would pay 5% in as well. And then what the employee gets out once they terminate employment or retire is the value of what that those contributions have grown to over the years with investment earnings.
Okay. So then in the defined contribution plan situation, the employer isn't responsible for any final outcome or output. It is what it is. Though they may be, though they are responsible for either managing the fund or providing options for the employees to of what they're going to invest in. Is that correct?
That's right. Yeah. So on the defined contribution side, the employer has some fiduciary responsibility for plan design, plan compliance, and then which would include investments, et cetera. But the employee is contributing to that. The employer might be matching those contributions, and at the end of the employment relationship, the whatever is in that account is payable to the employee, and the employee has responsibility for managing that going forward.
Okay. So, a lot of people they like the idea of the old defined benefits pension because, they there's not anything you have to do. You don't have to worry about managing the money. You don't have to do a lot of different things. It's just something where, you get your check. Um, those are generally not very common nowadays, my understanding.
Correct.
And so now we have this whole defined contribution model, which is harder for employees to navigate. And so, in your role, if I'm understanding correctly, um, your direct customers are the companies that you've done the defined benefit, you've done the defined contribution, you've helped companies with investment management, and you are serving as a consultant or in a role where you're assisting those companies in managing these programs, correct?
Right. Yeah. So historically we have and still provide that consulting and advice to the corporations as they design those plans and manage those plans as they need to going forward. But typically it has that's where the relationship has ended. We might provide some education on the particular plan design elements to employees, but historically it's been 95% of our effort has been helping the employers manage those plans.
Okay. And what percentage, because I mean, you're going to have a lot more insight into this than most people. What percentage of plans are defined contribution versus defined benefit these days?
Oh gosh, you're asking an actuary. I'm trying to get down to the nth degree. I would say that
Ballpark works.
yes,
That's going
I
to be
would
much better
say
than most people have.
85% are defined contribution and 15% are defined benefit.
Okay. I
And
actually
and
thought
and
defined
then
benefit would be lower.
maybe there's a lot of plans. There's a lot of legacy plans out there, so they're not active. They're just so yeah. So let me clean that up a little bit. So so there's a lot of dormant defined benefit plans out there where employees aren't continuing to earn benefits in the future, but they're still being managed by companies. Now, as it relates to how much of, let's say in the US, of employees in the US, what percentage of employees what percentage of a retirement benefit that's being provided to an employee, let's say in 2025, 95% of their retirement benefits going to be provided under a defined contribution plan as opposed to a defined benefit plan.
Okay, so you have these defined benefit plans that are running off because promises were made, and so the fund still has to be managed, and the promises still need to be kept over time.
Exactly. Yeah.
Okay, cool. Got it. So, what are you hearing from your corporate clients? What is it that they're telling you about the space, about their employees, about managing retirement?
Yeah. So that's a good question. I would say historically our clients would have said, "Hey, just help me with my plan. I don't really need you to talk to my employees. Um, they we've got our internal message. Just don't you don't need to talk to our employees about anything per se." I mean, they didn't really go down that path. But today they're saying, "Hey, my people need help from a financial well-being perspective." And so they're saying, how can you help? When we get hired or before we get hired by an employer now, if we don't have a message around financial well-being, and not just a message, but tools around financial well-being, and that could be just basic education, helping employees with budgeting, um, college tuition, college saving, maybe it's a mortgage, maybe it's retirement. I mean, I was reading something this morning, and I think it's of people that make under $100,000 a year, more than 60% of them are living paycheck to paycheck. And so it's really the employers are saying, hey, you have a lot of financial well-being expertise in your organization. Help my people with education broadly, not just retirement, but back to simple budgeting maybe. Provide them one-on-one coaching if you can, which we do. And then if you can help with financial planning, that would be also a benefit because so basically we're being asked to be all things to all people from a financial well-being perspective for our corporate clients.
That's really interesting. So it sounds like it used to be you guys were really more on the high finance side of the investment and structuring, the plans and all this kind of stuff, and you're moving into more of a financial planning and financial literacy role, if I'm hearing you correctly.
We are, yeah, exactly. That's for us to get hired by our corporate clients these days. For a new corporate client, we have to. Those are table stakes now. Basically,
Really?
being able to provide that. Yeah.
Wow. So what do you think? What do you think is driving that?
Well, so it's the what a lot of people are realizing is the impact of stress that's created by an individual's financial situation. and then the impact of that stress on productivity and quality within an engagement within a corporation. So people are bringing that stress to work, which you can imagine means people don't just cut it off when they cross the threshold of going to work every day.
Mhm.
And employers are saying, "Hey, how can you help my folks?" I mean, some employers are more paternalistic than others, and so they might be doing it out of the goodness of their hearts. But other employers are saying, "Hey, it's really impacting the engagement of my people in their day to day, and the impact on the productivity and quality of the work that we're getting out of our workforce."
Okay, so and so I assume, given the rise in interest rates and how that affects expenses and financial ratios and finance departments, right? There is a desire to not necessarily just pay everybody a whole lot more because there's only so much resources to go around. And so they're saying, hey, listen, how can you help people get more out of what we're paying them so that that there can be a win-win on both sides?
Yeah, I think it is. It's about how to help people with that. Yeah, it's not about let's give people more money to have them be able to cope with their financial stress, but it's help them make better decisions,
Mhm.
um, and then help them make better decisions today that will impact them tomorrow. So, it's kind of interesting. Our coaches will get calls from people trying to understand, and this it's totally understandable. Someone is going to buy a car, for example.
Mhm.
So should I don't have the cash to buy the car, but should I finance it? Should I get a 3-year loan, a 5-year loan? Should I lease it? So it's really having someone that can help them understand all the mechanics of that. Oh, and if you get a lease, did you know that there might be some back end charges if you decided you're not going to keep that lease so that people don't get surprised? So it really is about helping people understand all the different elements of it so they make better decisions as they're moving forward.
Yep. Yep. It's almost like the financial equivalent of preventive healthcare.
Yeah, that's fair. Yeah. 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 It's pretty, and it's really rewarding from our perspective, because a lot of us go through this in the financial space. This is how we grew up. We kind of know these things, and when we start having conversations with broader populations and realize that not everybody learns this stuff in school or through their professions, but we have a lot of information we can relay to people, and that really helps them out a ton.
Yeah, I mean, I imagine it's a world's difference from just straight actuary work that you used to do.
Yeah, I mean, constructing mortality tables is fantastic, but we can actually help someone with their financial situation. It's really, I mean, it's really rewarding.
Cool, cool. So what are you hearing from the employees as you speak to them?
So yeah, it's kind of interesting. There's a lot of the good news is there's a lot of aha moments. Oh, I didn't understand that. Oh, help me think about this one. So we get to the next one. But it's also how can I, to kind of almost back to your point, how can I get more out of what I have today? And so it's getting them on to how can you help me get to um, on the path and get to a path of growing my savings. So maybe I can only afford to save $150 a paycheck. And maybe that's not going to get me to where I need to be so I can retire at, let's say, 65. But how do I get from 150 to 200 to 250, et cetera? So it's really, we do get a lot of callbacks so that we can help people continue along their path.
Okay. So you mentioned that there's some big aha moments. Can you share a couple, maybe two or three that to give some examples?
So one is, I think it's the understanding of what will be when we get into a retirement conversation, for example. Kind of going back to that is, I think a lot of people don't understand the Social Security, what that provides, and what some people just don't think it exists for them, which is usually an aha for me. It has been an aha for me, but now I understand that a lot of people don't get that. then when they understand that, oh, there is something for me, there should be something for me at age 65 or 62 or 60 or 70, depending on the person's retirement age. But then it is, okay, that gets me a certain way to replacing my income, pre-retirement income. But then it is, okay, if I only contribute $100 a month, how's that going to get me to where I need to be? And then there's if I start earlier, here's how that $100 a month. If I start today, here's how that can grow. If I had started earlier, here's how it could have manifested. And that actually helps us help people educate the broader population. But anyway, so it's how does that money grow? That's another one of the big ones. The other piece is
So just to pause there. So the first one you mentioned was like Social Security is a thing, right? Hopefully we'll still
yeah.
But then the second one is you're talking about when people start saving and how it compounds over time. So is this where people are like getting the whole miracle of compound interest thing?
Yeah, it is, and understanding it is. Yeah, so that aha moment of $100 a month is going to grow to this. Holy cow! I didn't realize that. So, so it is that, and then the other piece along that line is that it needs to be invested. You can't just put it in a bank account, a savings account, and it's going to grow to this. You need to take advantage of some of the market dynamics and look at, there's no promise that it's going to happen, but it's better to put it in, if you have a long-term horizon, put it into some investing mechanism other than a savings account.
Yep. And I think one big thing here is that most people don't understand exponential math, right? Like most people I would say aren't math people. You and me are math people, right? Like I used to be financial quant. Obviously, you've been an actuary. Like we get this stuff. But for most people, exponential math is kind of foreign. So one, the concept that if you save, let's say you start saving, 10 years earlier out of a 30-year track. So the difference between 20 years and 30 years is not, the same as the difference between 30 and 20. It's not a 50% at all.
It's not right. Exactly. Right? That's fair. That's right.
Because it scales exponentially. And then likewise on what is that rate? If you put it in, say a high yield savings account, right? And you're getting, a couple percentage points, the difference between getting, say, 4% or 3% and getting 10% in the market over the long run isn't going to be a triple. It's actually going to be a lot more than that.
Right.
Compounding works.
Right. So yeah, so that what's interesting about that is what we've learned is how to stage that conversation, because it's a lot to digest. You and I, like you said, you and I are in this business. We've learned this over the years, and it becomes second nature to us. So what we've learned on our aha is that we need to take it slow and get people to that realization.
Yeah, that makes a lot of sense. I think it's easy for financial professionals to assume that other people have, even if not the same level of knowledge, like, 20 units of knowledge, where like the average person may only have like 5, because this isn't anybody's fault who doesn't have this knowledge, but it's not taught in schools. Frankly, I think it should be.
Right.
And so the financial literacy is poor because our education system just doesn't prepare people for it. And
right.
So this is where, somebody like you is stepping in and really filling that gap for people. And so, first off, hats off to you.
Yeah.
Probably not where you thought things would go from the beginning actuary days.
Right.
But it sounds like it's really fulfilling. It sounds like it's really rewarding.
Oh yeah, it is. And and again, it's what our clients are asking for, so we tend to, instead of basically just saying, hey, here's a black box that we have to give you, we listen and this is what they need. And so we're creating, fulfilling that need. So, and it's good. So it's very rewarding. Yeah.
Yeah. I think, it's interesting. I'm just now realizing as we have this conversation that the financial services of the future, right, is going to rely a lot more on this human element. It's just like the healthcare of the future is going to have to rely a lot more on the human element, on education, on lifestyle changes. Finance has kind of been really ivory tower for a while. And if we actually want to produce better outcomes with a limited amount of resources, I think it's really important that we do have more of these interactions, more of these education, more of being involved. And that's one of the reasons why, we're doing these webinars, right? Is to help people gain that knowledge, because ultimately I do think um, that's what's ultimately going to matter for people in the long run. They've got to have that.
Yeah, that's a good point. What's interesting is we have developed our financial well-being platform that we're providing to our clients, corporations, who then therefore we're providing to their employees. We felt like early on, 4 or 5 years ago, as we started down this path, that it would be robo-like, that it would be um, we could just basically inform. It would be a digital offering that would take off. And just given everything with from an AI perspective, all of the digital components of our lives, we thought that would be the case. And now, 5 years into it, and we've been going along this a little bit longer than 5 years, but we're now saying we need boots on the ground because people want to talk, and whether it's literally or figuratively speaking, people want to talk to our clients, our end clients, the employees. They want to talk to somebody, and it's interesting. Even people who are very sophisticated from a financial perspective, they get themselves to most of them get themselves to the point of making a decision and pulling the trigger. But they really, at the end of before they make that decision, they want to talk to somebody to make sure that it's the right thing, because it's such a personal, it's an asset, and they don't want to screw it up. So that's one of our aha moments, is we really need to have boots on the ground, or people to interact with our end client, because they want that. It's not a guarantee, but they just want that feeling of, yeah, someone else believes this is the right decision for me.
Yeah, it's interesting because I used to be a investment advisor representative myself, and I remember
Yeah,
10 years ago there was this terror going through financial advisors about the robo-advisors are coming, and we're all going to be out of a job, and it's going to be the end of days, and
right.
it was very prevalent. There was a lot of fear narrative going around in the financial advisor world, and it turned out that it didn't end up playing out that way. The robo-advisors did not take this huge share of capital that everyone expected them to take. I mean, obviously there's some that are still around, um, but I think you kind of hit on it. Like, people want a person to talk to, because it's not just mechanical decisions, right? I think
Right.
there's an element of comfort of feeling seen and heard and understood, that plays a role in it. I also think that there's an element of psychology that a robo advisor just can't manage the same way that a human can. Almost like there's a coaching element to it almost.
Right. Well, and it's not just one component too. I think it is. Um, I think that it's not just saving for retirement, for example. There's what's my life insurance? What do I need from a life insurance perspective? Do I need additional disability coverage? Do I need to be thinking about long-term care? What's the impact on my health care? And so it's really complex and as well as complicated. And not that a robot, not that AI couldn't do it, but it's just that human element that is really is not going. I don't see it going away. I thought it would go away, but it's really not going away.
Yeah. I mean, I'm not super well informed in the market, but to my knowledge, I haven't seen a robo advisor that takes into account all of those complexities really effectively. It could be done, I think. I think it could be done, but I
It
haven't seen.
could be, because there are, I think there are. You see it with, I don't know if it's Google or eBay or whatever. The people like me bought these things, when you go on, and so there are a lot of people who have the same situation. Just by nature of who we are, we all, there are a lot of people whose situations are similar. So you probably could go down that robo advice, but people it's too personal.
Yeah. Yeah. I mean, it's just like, imagine like getting all your health advice from a robot and never talking to a doctor.
Right.
Most people wouldn't be okay with that.
Right. Right. It's true. So, which is good. It's good for us. Good for the humans.
Yep. So, so what's the most common advice that you find yourself giving people, employees in these situations?
Well, save early is probably the most common, um, and try to utilize that savings element. So start early, increase your contribution over time, and and take advice. Look for resources, whether it's online resources or face to face or virtual, and then spend time on it every year. Whether it's make a monthly commitment, but at least make a quarterly commitment to review where you are. Actually, I didn't mention this. Set goals in the beginning and review where you are as it relates to those goals. And if you didn't make the goals, don't beat yourself up. Reestablish, go forward. If you've met your goals and you can do something different, that's fantastic. Do that, but it's just it's not a set it and forget it type of arrangement. So it is. So that's kind of what I try to tell people.
Yep. I think one thing that's interesting is that most people don't know how they spend their money. So like
Mm,
in the financial coaching world, one of the most basic exercises that's done, it's absolutely crucial, is just doing a budget of like, where did your money go last month? Account for every
right.
dollar of where it went, right? It's just a math exercise. Right? It's
Yeah.
just your cards and your bank accounts, and map out where every dollar went. And most people are actually really surprised by those numbers, believe it or not,
They
because
are. So that's
so
interesting. So you're right. That's a really good point. And so when people, as we go through those conversations, getting to the point of, we don't just start by saying, hey, you should start saving $100 a month, because people can't fathom that if they're living paycheck to paycheck. But going through the exercise that you just mentioned creates that opportunity that people can see. Oh, I didn't realize it. I was watching TV yesterday, watching a football game or something, and there's one of those apps that help you get rid of subscriptions that you had no idea you had.
yeah,
So,
yeah,
I
yeah.
mean, there are people, as they go through to see actually how they're spending their money. That's how they realize, oh, I can take $100 a month and save it for retirement or save it for the future, instead of sending it to these 7 different subscriptions that I don't use.
Yep. Yep. I was talking to a friend this weekend. I was visiting for their baby shower, and so my friend's involved with speakers and all this kind of stuff. And so they had been talking, one of the people speaking was Kevin O'Leary from Shark Tank.
Mm, yeah.
He's wonderful. And he was saying, he was like, listen, if you're a business owner and you don't know your numbers, every
Oh yeah.
item of your numbers, I'm not interested. Game over.
Right.
It's almost like that philosophy kind of applies really well in personal finance as well. You should know your personal finance numbers
Right.
item by item. How much you spend on gas, how much you spend on food, how much you spend on rent, how much you spend on insurance, how much you like all this stuff, right? Um, because just having that knowledge opens up the ground for you to make some other different decision, because you can't make any different decision if you don't know where you're starting from.
Right. Yeah, and I think it's not hard to do that from
Right.
a just a mechanical perspective, but it is. I think some people beat themselves up over it once
Yeah.
they see the numbers. But you just kind of got to try to remove yourself from beating yourself up over it and just figure out how I want to reallocate my resources.
Yeah, I think that's a really, really, really strong point, is that people don't necessarily, there's an emotional component to it. Oh my God, I spent money on this, or oh my God, it's stressful to see what the situation is. It's stressful to see the amounts that are coming in, or oh, I'm not a math person, I'm not a numbers person. And so you get these psychological barriers that prevent people from doing, this simple and really helpful exercise. And I guess that's also a role where, as you say, a financial coach, kind of people who are on the ground and working with everybody, can really help shepherd people through that emotional component. And again, that's something you're never going to get from a robot.
Yeah, that's a good point. It reminds me of the stress of that is difficult. That's why I think some people avoid it, but it's kind of it reminds me of some of the business books I've read over the years, like having critical conversations. and how important that is to the success going forward of a team, or even, and it's in all of our relationships. When you think about, relationships that you have with your friends and family, having those, sometimes you have to have a difficult conversation, and it's good to just have it, get it over with, move forward. So I think it's similar from a financial perspective. It doesn't have to be difficult, but it's just, let's just look at my numbers and understand the numbers so I can figure out how to best to go forward.
I think it was Tim Ferriss who said, your success will be directly proportional to the number of difficult conversations that you're willing to have.
Oh, that's interesting. Yeah.
Right? Because
I,
that avoidance mentality just really doesn't help
does
anybody.
not help. You're exactly. That's a really good point. I totally agree with you.
Yeah. Cool, cool. Well, so Jeff, is there anything else that you'd like to share with our audience?
Well, I can't think of it. I think this has been a really good conversation about, just know your numbers, dig in, and if you don't understand it or you need help getting through it, I think find someone who can help you. There's a lot of people out there who can help and actually who are willing to help, because it's a really rewarding conversation.
Well, thank you, Jeff. Thank you for the work you're doing. Thank you for coming on with us today. I really appreciate it. And so
Thank you.
everyone, thank you for watching this webinar sponsored by Savvly, your personal pension designed to provide lifelong financial security and peace of mind. Have a wonderful day.